Now, when you particularly talk about the employees, specifically when we are talking about the directors, they get the remuneration from the company known as directors remuneration. And in this remuneration, there are multiple things. For example, there is a salary component, which is the minimum guaranteed portion the directors are getting. And there is a bonus. There are benefits, for example, gym and other, for example, car, medical allowances, annual subscriptions. Then you got the pension, which is the post-employment benefit, and then you have the share options. Regarding the share options, we have already discussed this in IFRS 2. And now we'll be talking about the other components of the director's remuneration or the employee benefit, which is salary, bonus benefits, and the pension. So all of these are covered under IAS-19. So we are going to talk about the employee benefit. It is going to be the salaries, it is going to be the long leaves, it is going to be the paid holidays, it is going to be the benefits, like for example, medical, the car. It is going to be the post-employment benefits, such as post-employment medical, such as the pensions. And the objective is to study the accounting treatment for all these sort of benefits. So IAS-19 defines the employee benefits as all forms of consideration. And now you can understand all forms of consideration means it can be a salary, bonus, benefits, pensions. All forms of consideration given by an entity in exchange for the service rendered by the employees. Now, there is an organization, there are employees. So for particularly talk about an employee will be providing the service to the organization or to the company, and organization will be making the payment against those services provided by the employee. So all forms of consideration given by an entity in exchange for service rendered by employees or for the termination of the employment. Now, like usually we call it as a severance payments. You have studied in your law paper that if the employees is being made redundant, terminated, even the entity pays them. So that is known as the severance payment. So that is the expense of the company as well. Now, whatever it is, either it is going to be a salary or it is going to be a bonus or it is the paid holidays, long paid leaves, or the pension. All of these are the expense of the company. So we are going to debit the expense. We are going to debit the profit or loss. But before making the payment, we usually book that in our financial statements, and that creates a liability. Like for example, when the bonus becomes due, it should be recorded as a liability. And when the bonus is paid, the liability is de-recognized and the cash is credited. Similarly, when the salary is due, you record that thing as an expense and the salary payable as a liability. And once the payment has been made, has been done, then you de-recognize the liability and you record the cash or the bank. So what we are doing is we are recording an expense and the liability. We're recording an expense and the liability. So that's the clear demonstration of the matching principle. That because the employee is providing us the services, and with the help of that service, we are doing the sales, we are incurring the revenue. So the expense should be recorded in the same period as well. So the organization is getting a benefit. Through that benefit, we are earning, and that earnings is recorded as revenue. So the payment which is being made to the employee for the services they have rendered should be recorded in the same period as an expense, and this is the application of the matching principle. Now, the IAS-19 has defined four types of the benefits. The first one is the short-term benefits, like, for example, salaries, wages, bonus, profit sharing arrangements, non-monetary benefits such as car benefit, medical care. These are the short-term benefits. Now, when we say short-term, that means it belongs to the 12 months. Like salary is usually contracted as per annum salary. So it belongs to the 12 months. It belongs to the single year. The bonus is for the particular year. The benefits are the annual benefits. So these are the short-term benefits belongs to the 12 months, and accordingly they should be expensed out within the statement of profit and loss. Then you have the post-employment benefits after the employment, like the pensions, and this is the main area of the standard. We'll be discussing mainly the pensions, which is of two types over here, defined benefit and defined contribution. We'll be dealing with that in a while. And similarly, the post-employment medical benefits, the post-employment insurance, that is the post-employment benefit as well. Then you have the other long-term benefits, such as long-term paid leaves, long-term disability benefits. For example, you're working with a company which extracts oil and they have a policy like, for example, if during the service you get a disability, the entity will be paying you for your whole life. There are such jobs in which the employer offers such payments to the employees in case of the disability during the service. Long-term disability benefits. These are the other long-term benefits. And then you got the termination benefits. Terminate an employee's employment before the normal retirement date, that is known as the severance payments the entity will be making to them. That is also the part of the benefits the entity is providing to the employee. So there are four types of benefits: the short-term benefits, the post-employment benefits, the other long-term benefits, and the termination benefit. Now, the accounting for the short-term benefits is simple. Like you talk about, the salary should be recorded in the same period. Bonus, it should be recorded in the same period to which it belongs. But when you talk about the post-employment benefits, such as pensions, how this pension should be accounted for. Similarly, the long-term benefits, similarly, the termination benefits, the accounting should be identified at how we are going to account for these transactions. Now, as the name suggests, short-term benefits, so these benefits belong to 12 months, and these will be expensed out in the same period to which they belongs. And there's no need to record them to the present value because within a year, we do not apply the principle of the discounting. Within the short-term benefit, there is the short-term paid absences. Now, every organization has a different policy for it. Many of you are working, so you can understand better that what I am trying to say. For example, in many organizations, they have paid leaves. Now, the concept of the paid leave is that there are certain paid leaves. For example, 15 medical leaves, 10 annual leaves. A total may be, for example, something regarding between 30 to 40. So if you are absent and you are availing those paid leaves, your salary won't be deducted. Now, the organization is paying you for that, so that should be recorded as an expense. But there are different policies in the every entity. For example, where I was working 8 years back, a company in which I was an internal auditor, they were having the policy of the leave encashments. For example, the paid leaves are given, and if you have not availed those leaves during the year, let's assume there were 30 paid leaves and I've only availed 5, 25 are remaining. So they were having a policy that they will be making you payment against those 25 leaves. Now, this is something other than the salary. And they were having a policy of time and a half. That means per day salary multiplied by 150%. Now, this is an additional expense for the company. So similarly, sometimes you have the company has a policy that they usually uh, carry forward those leaves. For example, I have not done this year, I may be able to avail in the next year, in the preceding year. So sometimes an entity may pay employees for absence for various reasons. These include holidays, sickness, and maternity leaves. Entitlement to paid absences fall into two categories. The one is accumulating and the other is non-accumulating. Like for example, I've not availed those leaves and that will be carried forward to the next year. So accumulating means carry forward for use in the future period if the current period's entitlement is not used in full. Fine, that's a simple thing. So what the entity needs to do regarding the accounting treatment. Expense and liability is recognized when employees render service that increases their entitlement to future paid absences. So expense and liability is recognized when employee renders service that increases their entitlement to future paid absences. Like for example, I've not availed those things this year. Now I can carry forward those things and in the next year I will be availing that. Measured at the additional amount expected to be paid as a result of the unused entitlement that has accumulated at the end of the reporting period. At the every year end, the entity needs to see how many employees have not availed, has not taken their paid leaves entitlement, and how much it will be transferring to the next year. So it seems that it is a difficult calculation, but nowadays we are having, the management information systems, we are having the ERPs in which there is a complete record of the employee. You probably, if you're working somewhere, you have seen that the employee has a code, and when you enter that code, there's a master file of that employee, the date of joining, and the basic hours, the standard hours, the basic rate, the basic salary, overtime rate, the pensions which are being deducted, everything is there. So with the help of the management information systems, with the help of the ERPs, it becomes quite easier to calculate the data for all the employees. But if you are maintaining a manual system, then obviously it becomes difficult if you do not have the proper and the required documentation. So non-accumulating, unused amounts cannot be carried forward because if you have to claim it, the policy is to make sure that when the employee is being given the holidays, they should avail it because they're humans. They need holidays, they need refreshments. If they're not availing it, then that means next year their efficiency will be affected. So the entity promotes the employees to avail their leave so that they have the required refreshment. Expense and liability is recognized when the absences occur. This may arise, for example, where an employee continues to receive their normal remuneration whilst being absent due to illness or other permitted reasons. So we have an example. The salaried employees of the entity are entitled to 20 days paid leave each year. The entitlement accrues evenly over the year, and unused leave may be carried forward for 1 year. The holiday year is the same as the financial year. At 31st December 2004, the entity had 2,200 salaried employees, and the average unused holiday entitlement was 4 days per employee. So you see 2200 are the employees, and unused average holidays 4 days per employee. Approximately 6% of the employees leave without taking their entitlement, and there is no cash payment when an employee leaves in respect of the holiday entitlement. So 6% will not be taking the benefit, and there is no payment as well. There are 255 working days in the year, and total annual salary cost is 42 million. So the total annual salary is 42 million. When you divide it by 255 working days, it gives you the salary of 1 day of all the employees. 42 million is the total annual salary. Divide by 255, it gives you the salary of the 1 day. No adjustment has been made in the financial systems for the above, and there was no opening accrual required for the holiday entitlement. Requirement is discussed with suitable computations how the leave that may be carried forward is treated in the financial statements for the year ended 31st December 20x4. So first of all, you need to calculate 42 million divided by 255. It is going to give you the per day payroll figure. Now you know the number of employees, they are 2200, 6% won't be availing it, 94% will be availing it, and 4 days per employee. So the calculation is simple. 42 divided by 255, this gives you per day salary, multiply by 94%, multiply by 4, and this gives you 6,19,294, which will be recorded as an expense in the profit and loss and as a liability in the statement of financial position. Now you have the profit sharing and bonus plans. Now, when the entity has announced any bonus based on the profits, based on the assets, or based on the revenue, they need to record that thing as an expense and the liability, because this is the short-term benefit, belongs to 12 months. The expected cost of the profit sharing and bonus payments must be recognized when and only when, like expected cost means that you're going to debit the profit or loss and credit the bonus payable. First of all, it is going to be the bonus payable. The entity has a present legal, like legal means here we are talking about a contractual obligation, like they have done the contract with the employees, and in their contract there is a clause that they will be getting the bonus or the profit sharing. Or constructive obligation, that means the entity has themselves made an obligation for them, like with their past practices, with their policies. Every year from a decade, they have been giving the bonus to the employees. Now, with their manners and with their past practices, with their norms, it is now their constructive obligation. So entity has a present legal or constructive obligation to make such payments as a result of past events, and a reliable estimate of the obligation can be made. So you can see this is a criteria of a liability. There are present obligation as a result of past event, and a reliable estimate can be made. So if that is the case, then the entity is going to record the expense, and the credit entry is going to be the bonus payable. So we have the example number 2. Moro Company runs a profit sharing plan under which it pays 3% of its net profit for the year to its employees if none have left during the year. Moro Company estimates that this will be reduced by staff turnover to 2.5%. Which cost should be recognized by Moro Company? Obviously 2.5%, because now the reliable estimate is going to be 2.5%. Now we will be discussing the most important thing of the IAS-19, because when in the exam you get the question, most probably it is going to be from this part of the standard. And this is the pension, which is the post-employment benefit. But before reading the slide, let me give you a complete flavor of these two types of the pension arrangements known as the defined contribution and the defined benefit. Now, let me give you the practical example. For example, a person is working in an organization and his salary is, let's assume, $3,000 per month. $3,000 per month. Now, if say, for example, I'm working in an organization and my salary is $3,000 per month. Now, the company have a different tactics, different policies to retain the employees. Like if I'm working somewhere, obviously I'll be thinking regarding the future that I have to make some money for the period in which I'll not be working for my old age and things like that. So the entity usually gives the employees the flavor that if you're working here, you will be ending up with the money which you can use in your later old age. So usually they have the pension arrangements for such things. Now the entity has a policy that they have made a plan, which is the pension plan. And in the pension plan, both the employee and the employer will be contributing the funds, both the employee and the employer. Like now the policy is, let me give you the practical example. The organization in which I was working, they were having a policy of 1 day salary deduction. So let's assume my salary is $3,000 divided by 30. So it is going to be $300 per day. $300. Let me just, sorry, 100 per day. So 3,000 divided by 30. Yes, it's 100. Sorry, 100 per day. Now, $100 will be contributed by the employee because it is deducted from their salary. And the similar contribution will be done by the employer. So that means $100 from the employee plus $100 from the employer. This will be the part of the plan. And usually these are, the pension companies which will be using the funds. They will be investing these funds. They have the financing activities, investing activities. After some certain number of years, these funds will be compounded to a particular sum, but we cannot say the particular amount. It can be anything based on the return on the investments. So what the employer usually do, that they are making a similar contribution in the employee's pension plan. Now, this $100 which is paid by the employee, this $100 which is paid by the employee is the deduction from his salary. This $100 which is paid by the employer is an extra expense for the company because they're giving them the salaries, they're giving them the bonuses, and in addition to that, they are giving a pension on behalf of them as well, a similar contribution. So we're going to record debit profit or loss as an expense and credit contribution payable. And once this contribution has been paid, the contribution payable will be debited and cash or bank credited. But the point that you are going to notice over here is that the employer is not going to guarantee any amount. This amount will not be any guaranteed amount. All the employers in the defined contribution plan will be contributing a particular sum based on the salary to the employee's pension plan, and whatever it earns by the end of the day, it belongs to the employee. An employer won't be giving any guarantee regarding the end figure which the employee will be getting from the pension plan. So remember one thing, that as the name suggests, in the defined contribution, only the contributions are defined based on the salaries, and that contribution is an extra expense for the company, but final amount is not guaranteed, not guaranteed, not guaranteed. This is the defined contribution thing. Now let's come to the defined benefit plans. As the name suggests, that the end benefit is being defined in advance. For example, based on the number of years of service, based on the final salary, the ultimate benefit is defined. The ultimate benefit is defined. For example, this much amount is defined. Now, the process is that once the employer has defined a value that they will be paying to the employee, the guaranteed amount, they are not going to do this way that by the end of the, for example, 10 years and 15 years and 20 years, they're going to see their bank account, how much money they have, and they're going to write a check and they will be giving this amount to the employee. No, this is not the case. They will be making that amount. They will be making that amount. Now, when I'm saying making, that means they will be going to the actuary and they will be asking that, okay, we have to pay this much amount to the employee by the end of the 20 years, this much amount. How much we should invest today in the plan so that after certain number of years, it reaches this amount which we have guaranteed. Now, the pension companies, they are the institutional investors. Institutional investor means the pension companies, they have the investment in many companies. They buy the gold as well. They buy the shares. They buy the debentures. They do different sort of investments in different companies and they make return from that. And that return is used to pay for the pensions. So the employer will be making an actuarial assumption that how much we put in the plan today, including the employees' contribution as well, how much we put in the plan so that after some certain number of years, it makes the same amount what we have guaranteed to the employee. Sorry. Now remember one thing, that these are based on the rate of returns. These are based on the percentages we are earning from the money we are investing, and it can vary every year. So what we're going to do is we are maintaining a plan asset in order to meet the plan obligations. Because in the defined benefit, the ultimate amount is defined by the employer. So the employer will be investing in a way that their plan assets generates the same amount that they have to pay to the employee after some certain number of years. There's no other objective. The objective is to just fulfill that amount that they have guaranteed. So based on the assumptions, they will be putting the money into the plan, which is known as the plan asset, in order to meet the plan obligations. So by the end of every year, the fair value of plan asset should be equal to the present value of obligation, because we know from the previous standards, when we have a future guaranteed amount, we need to calculate the present value of the year. So by the end of the every year, we're going to see whether the fair value of plan asset, now fair value of plan asset means the assets which we have invested, should be equal to the present value of the obligation. The present value obligation means this is a discounted amount of the future obligation. If the fair value of the plan asset is less than the obligation, that means the plan is in deficit. And if the fair value of the plan asset is more than the plan obligation, that means the plan is in surplus. The objective is to make the payment which is guaranteed and nothing else. So the difference between the defined contribution and defined benefit is that in the defined contribution, employer has only one responsibility, which is the regular contribution payable and nothing other than that. In the defined benefit, employer has two responsibilities. The one is related to the contribution they will be making into the plans. Another is the extra money they need to put if the plan is in deficit, because we know we have taken the assumptions, and based on the assumption we are injecting amount in the plan asset so that it meets the plan obligation. When the interest rate changes, when the percentage of return changes, maybe you're required to put more money into the plan, more money into the plan in case of shortfalls. For example, if your contributions are not enough to fulfill your plan obligations, then you need to put extra money to equal it. So in the defined contribution, there's only one obligation, which is the regular contribution. And in the defined benefit, there are two obligations of the employer. One is related to the regular contribution. That like this is actually the entitlement based on the employee's salary. With the entitlement, the number of years employee is spending, their entitlement to the pension is increasing. Their pension is increasing. But this is known as actually the service cost, which we'll be discussing in a while. And then you have to put some extra money sometimes in order to make up the shortfall. So these are two responsibilities in the defined benefit plans. Okay, now we can have a read from the notes on the slides. A defined contribution plan. An entity pays fixed contributions of 5% of employee salaries into a pension plan each month. It can be anything, any policy. The entity has no obligation outside of its fixed contribution. We have already discussed it. The lack of any obligation to contribute further assets into the fund means that this is a defined contribution plan, because if there are no guarantees, now this is a very important point, because in the exam, examiner gives you a case study with some different sort of information, and they ask you, which plan is this? Is this a defined contribution or a defined benefit? We'll be doing an example as well. A defined benefit plan, an entity guarantees a particular level of pension benefit to its employees upon retirement. The annual pension income that employees will receive is based on the following formula. Usually this formula is used. Salary at retirement multiplied by the number of years worked, divided by 60. The entity has an obligation to pay extra funds into the pension plan to meet the promised level of pension benefits. This is therefore a defined benefit plan, which you need to understand. Now we have a test understanding number 1, and I will be asking you that which plan it is, whether it is a defined benefit or the defined contribution. Okay, let's read it. Deller has defined contribution pension scheme. However, during the year, it introduced a new post-employment plan for its employees as a way of enhancing the benefits they will receive when they retire. Okay. Deller makes monthly contributions into the fund that are equal to a set percentage of the salary cost. Upon retirement, employees will receive annual payments from the fund based on their number of years of service and their final salary. The fund is voluntary and Deller can cancel it at any point. Dalar has a history of paying employees benefits that are substantially above the national average with annual increases in excess of inflation. Dalar has won many accolades, that means industry awards, as a top employer and received positive coverage from the national press when the fund was announced. The leadership team are well trusted by the employees. So there is a pension scheme. However, during the year, it introduced a new post-employment plan. Already they have a defined pension contribution, but they have introduced a post-employment plan for employees as a way of enhancing the benefits they will receive when they retire. Dalar makes monthly contribution into the fund that are equal to the set percentage of salary cost. Upon retirement, employees will receive annual payments from the fund based on their number of years. The fund is voluntary. Dalar has a history of paying employee benefits that is substantially above the national average with annual increases in excess of inflation. And they have won the industry awards based on this thing. So the requirement is advise Dalar on whether the fund is a defined benefit plan or a defined contribution plan. We are talking about the new pension plan they have introduced, which they are calling as fund. So yes, according to you, is this a defined benefit or a defined contribution? All right. So if you see the test understanding in the first paragraph, it seems this is a defined contribution plan because Dalar makes monthly contributions, which is based on the salary. It seems a defined contribution, but other than defined contribution, even in the defined benefit, the employer makes the contribution. So the contribution thing does not state that whether it is defined benefit or defined contribution, because in the both defined contribution and defined benefit, the contributions are made by the employer. Upon retirement, employee will receive annual payments based on their salary. Now from this, we can have a flavor that based on their last salary, based on their salary, they will be getting the funds. It seems this is a defined benefit. The fund is voluntary, so that means Dalar can cancel it. So that means it's something not obligatory. It gives the flavor again that this is a defined contribution. But again, in the last paragraph is very important, and it says that Dalar has a history of paying employees, so that makes their constructive obligation. History of paying employee the benefits, which is more than the national industry averages, and they also incorporates the inflation in it, and they have earned the awards, industry awards based on this. So as a result, the fund should be accounted for as a defined benefit plan because they have the constructive obligation. Although it was not a legal obligation, but they have constructed it for themselves from their past practice, and they have received the industry awards, and they are a well-reputed organization. The leadership team are well trusted by the employees. Now, accounting for the defined contribution plans, that is simple. First of all, you're going to record the expense, debit, profit or loss, credit, contribution payable. And once these contributions are paid, debit, contribution payable, and credit bank. So this is the entry of the accrual, that expense which belongs to the current year but still unpaid. Sorry, the above one. This is the payment entry. This one. This entry is for accrual. It is possible the entity pays the contribution in advance. In that case, it should be recorded as the prepayment, like prepayment. Prepayment is debit prepaid expense because we treat that as an asset, credit cash. In that case, it should be recorded as an asset. So when you have paid the contributions in advance. Example number 3, an entity makes contributions to the pension fund and employees at a rate of 5% of the gross salaries. For convenience, the entity pays 10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. The wages and salaries for 20x6 are 2.7 million. So 2.7 million multiplied by 5%, it gives you 1,35,000. Now the entity pays 10,000 per month into the plan. So how much they have paid? They have already paid 1,20,000. But the expense for the current year is 1,35,000. So how much is still remaining? 15,000 is remaining, which should be recorded as an accrual. So the double entry is going to be debit profit or loss, 1,35,000. Credit cash, 1,20,000. Credit accrual, which is a liability, they still have to pay 15,000. So this is how you are going to record the defined contribution. Okay, now we have the example number 4, again, defined contribution. Mouse, a public limited company, agrees to contribute 5% of employees' total remuneration into the post-employment plan each period. In the year ended 31st December 2009, the company paid total salaries of 10.5 million. A bonus of 3 million based on the income for the period was paid to the employees in March 20Y0. Okay, so salaries are 10.5 million. The bonus is 3 million. The company had paid 5,10,000 into the plan by 31st December 20X9. Required, calculate the total profit or loss expense for the post-employment benefits for the year end and the accrual which will appear in the statement of financial position. Now we know the salaries are 10.5 million, sorry, and the bonus is 3 million. So total it is 13.5 million. So 13.5 million into 5%, because we calculate the contribution based on their remuneration. So 13.5 million multiplied by 5%, it gives you 6,75,000. This is an expense that should be recorded in the profit or loss. Till now, they have only paid 5,10,000. So 1,65,000 should be recorded as an accrual in the statement of financial position. But remember, if you're having such type of question in the exam, so you have to narrate it first and then write in the similar way in which I have written. For example, you will be starting that the 5% should be applied to the total remuneration of the employees. The remuneration includes salary and the bonuses. The figures are calculated as, so just try to write 2 to 3 lines as a narration and then show your calculation. Just don't show your calculation straight away. Just try to narrate it and then do the calculations. Okay, now we have the defined benefit. We have already discussed it, that what the entity is doing, they are maintaining a plan asset in which there will be the contribution of the funds. And this plan asset should be able to meet the plan liability or the plan obligation. So every year, the fair value of plan asset should be equal to the present value of obligations. So if the present value of obligation is greater than the fair value of plan asset, then the plan is in deficit. And if it is vice versa, then the plan is in surplus. So defined benefit plans, post-employment benefit plans other than defined contribution. Typically, a separate plan is established into which the company makes regular payments as advised by an actuary based on the rate of returns they will be getting. This fund needs to ensure that it has enough assets to pay future pensions to the pensioners. The entity records the pension plan and liabilities in own books and as it bear the pension plan's risk and benefits. So in substance, if not in legal form, it owns the asset and owes the liabilities. Like even if you are managing it through a pension company, you will be recording the pension asset and the liability because you have the risk and rewards pertaining to the pension, uh, pertaining to the pension plan assets and the plan obligations. Now, what is the complexity in it? We have already discussed it that you have to take a lot of assumptions. You have to take the best estimate because your contribution is assessed based on the rate of returns the entity will be having. So there are a lot of calculations involved in it. There are a lot of estimates involved in it. There's a discounting involved in it. So there is a complexity. The method which is being used for the actuarial calculations is the projected unit credit method, and like it considers many things. For example, demographic assumptions like mortality rates, the death rates, and similarly financial assumptions such as future salary rises like the increments and the inflation impact. All these factors are considered, and these are the financial analysts who are going to do these calculations for you, and based on that you will be deciding your contributions. Now, how we are going to account for the defined benefit pension plans? Let me just show you the summary. How we are going to record, how we are going to account for the defined benefit scheme. So remember, there will be three things: figure in the profit or loss, figure in the other comprehensive income, and figure in the statement of financial position. In the statement of profit or loss, there's going to be service cost. Now, service cost has many components: current service cost, past service cost. We'll be discussing that in a while. And net interest component. And then in the other comprehensive income, there's a remeasurement component, which is actually due to the changes in assumptions. And in the statement of financial position, either it is going to be a plan obligation or the plan asset, not both of them, plan obligation or the plan assets. And there is going to be an asset ceiling concept applied, which we'll be studying later, but this asset ceiling applies on the plan asset concept. So that means there are three figures which you will be recording in terms of defined benefit pension plans. The first in the statement of profit or loss, which is the service cost and the net interest component. Then in the other comprehensive income, you will be having the remeasurement gain or loss. And then in the statement of financial position, there will be an asset and the obligation. And when there is an asset, the asset ceiling concept will be applied. Now, what is this service cost? What is this remeasurement gain or loss? We'll be studying it now. So under a defined benefit plan, an entity has an obligation to its employees as they have guaranteed the amount to be paid. The entity therefore has a long-term liability because they will be paying that thing in the future. And when you have the long-term liability, it should be brought to the present value. The entity will also be making regular contributions, and which is being set by the actuary. These contributions will be invested, and investment will generate returns, and these returns will be used to make the payments for the pensions, which is an obligation of the company. This means that the entity has assets held within the pension plan, which IAS-19 states must be measured at fair value, which I told you that the fair value of the plan asset should be equal to the present value of the obligations. On the statement of financial position, an entity offsets, because I said you that either it is going to be a plan asset or either it is going to be a plan obligation. If the plan is in surplus, then asset. If the plan is in deficit, then it is going to be the obligation. Now, this is the working we'll be discussing in a while. But before that, let's discuss the current service cost. Now, you know the amount that is going to be paid to an employee after a certain number of years. Let's assume after 10 years, 15 years. Because you know the amount, which is the future amount, you are going to bring that amount to the present value. So as we know, the liability should be discounted. The present value is calculated. Now, as we know, when present value is calculated, this is not the amount that will be actually paid. The actual amount that is going to be paid is the full amount, the future value. So every year, you have to systematically increase your obligation. When the employee is spending a particular year, his entitlement is increased every year for the pension. That year 1 has passed, 1 year entitlement done. Year 2 passed, 2 years entitlement is done. So the increase during the year in this obligation is called the current service cost, which is shown as an expense in the profit or loss. That means the double entry is going to be debit profit or loss and credit obligation, because with the current service cost, the obligation will be increased, just like we do the unwinding. In effect, the current service cost is the increase in the total pension payable as a result of continuing to employ your staff for another year. They have passed 1 more year, so they are now entitled to 1 more pension. This will increase your liability. And which rate you are going to use for discounting the future value to the present value? The discount rate used is determined by reference to the market yields at the end of the reporting period. Returns, the yields, that simply means returns. Reporting period on high quality corporate bonds. The returns the entity will be getting. So those yields, those returns, that rate should be used for discounting the present value. Now, past service cost. It is possible that the remuneration is changing. And when the remuneration is changing, there will be a change in the pension as well due to that. So the past service cost is the increase or decrease in the present value of the defined benefit obligation for employee service in prior period resulting from a plan amendment. Like for example, changes to the salaries, an introduction or withdrawal or changes to the defined benefit plan, or a curtailment. Now, curtailment means when there are redundancies. For example, the reduction in the number of employees, that is known as the redundancies. So when there are redundancies, there will be a decrease in the pension plan. So the past service cost is associated with the change in the present value of the obligation. So if it is increasing due to that, the double entry is going to be debit profit or loss, credit present value of obligation. Otherwise, it is going to be an opposite entry. So the past service cost is associated with the change in the plans. If due to the change in the plans, the more cost is incurred, and that will increase the liability. So that should be recorded as an expense, and the corresponding obligation should be increased. Now, interest basically is a net interest component, because you will see in the working There are different methods of doing the working of this IAS-19, but what I'm showing is the most simplest method. Many students, in many books, many tutors, what they do is they make a separate T account for the plan obligation and the separate T account for the plan assets. But what we do is the statement form working, in which we take the net assets or net obligations, like as obligations minus assets. We take both of them along, not separate T accounts. So obligation minus asset. And that's why we call it as a net interest component, because we multiply the interest on the net amount. So we call it as a net interest component. Otherwise, if you are maintaining two separate accounts, then the interest on plan assets is income. The interest on plan obligation is an expense. So you multiply separately the interest on it, and then you take the net amount. So better is to do a collective working. So that is why we call it as a net interest component. So if there is a net asset, when you multiply that net interest, it is going to be an income. If the above figure is an obligation and then you apply the net interest on it, that is should be recorded as an expense. So you see, we are going to take opening balances, obligation minus asset, the net amount, the net interest component, the service cost component, which includes the current service cost, the past service cost, and then the curtailment cost, like for example, when there is a reduction in the number of employees, that will gives you the curtailment gain or loss. Now the curtailment gain or loss means when you are reducing your obligation and paying more, or for example, you are paying less than your obligation, this will give rise to the curtailment gain or loss. We'll be doing an example related to that. And similarly, there will be the contributions into the plan. But you see that with the benefits paid, I have not shown any figure in the working. What is the reason behind that? Because we are taking the collective working of asset and liability. When the payment is being made, it will reduce both the asset and the liability. So that is why I have not shown any movement, because we are doing a collective working. When the payment is made, it will reduce both the asset and the liability. So that is why you see there is no movement in front of the benefits paid. The contributions paid into the plan, these are the cash payments paid into the plan during the reporting period. And we do not record the cash payment as an expense. We record the current service cost and the past service cost as an expense rather than the cash payments. Benefits paid, when the benefits are paid, it will reduce both the asset and the liability. So basically it's the debit liability, plan liability, and credit plan asset. So that is why we do not show any movement in front of that. So we have reached till here. Now you see the closing balances. These are the opening balances, assets minus liabilities, or liabilities minus asset, and then you get the closing balances, obligation minus assets. But there is a remeasurement component which should be recorded in the other comprehensive income. What is that? Because we are taking the assumptions, and based on the assumptions, we are calculating the figures. It is possible that at the end of the day, the actual figures, the actual scenario is different from our assumptions. That will give rise to the gain or loss, which should be recorded as part of the other comprehensive income. So after accounting for the above, the net pension benefit will differ from the amount calculated by the actuary. This is for the number of reasons. The actuary's calculation of the value of plan obligation and asset is based on assumption, and these may be changed. The actual return on plan assets, which we are assuming that we are getting from investments, may be different. So this will give rise to the remeasurement component, and remeasurement component is either a gain or a loss, but that is something unrealized. So we record that thing in the other comprehensive income. And this is the summary. In the profit and loss, we are going to record the current service cost, past service cost, which is the service cost, and the net interest. In the other comprehensive income, we are going to record the remeasurement gain or loss. And in the statement of financial position, it is either going to be a plan asset or plan obligation, but there is a concept of asset ceiling, which we will be studying later on. So you see this format. Opening balance, assets minus liabilities or liabilities minus assets, net interest, service cost, contributions, benefit paid, no movements, and then you compare this with the closing balance, it will give you the remeasurement component, which should be recorded in the other comprehensive income. So this is an example which you can do yourself for having a grip on the concept. And you can see from the solution that you just have to put in the format, and rest is going to be easier for you.